Now, today's auction left Treasuries little changed after the U.S. sold a record $43 billion worth of two-year notes. George Goncalves, chief fixed income rates strategist at Cantor Fitzgerald, joins us now to discuss the first of these three auctions of $112 billion total value of notes this week. George, great to see you again.
Thanks for having me.
So a bit of a mixed outcome, right? The yield came in a little higher than expected for the two-year, 1.034%. But the bid to cover came in very strong, 3.23% versus 2.68%, which according to your research was the last two-year auction bid to cover.
That's right. And I think the interesting thing we have to be very careful with in terms of splitting hairs of how close these yields are and how low they are, that they might seem that there's more at play than what
it's really a rounding error
It's
today.
Rounding error, exactly. So it's not a bad auction. It almost feels to me like we're having a groundhog effect where every auction comes and goes without much fanfare.
Why do people love our debt?
There's still a view around the world, and I think growing in the U.S., that the store of value still resides with the most deepest and liquid markets, irrespective of what's happening with the dollar. So the dollar is doing its own thing, doesn't have to derail the bond market in any way.
It is a disconnect. So, and this is in addition to the fact that everyone thinks the Fed's going to keep rates near zero.
Yeah, I think in the front end we're seeing more of a preference for those that can borrow very cheaply in the front end and go out into very liquid, deep markets like the Treasury market and earn free carry, earn free interest, basically rolling their securities month in, month out. At some point that will be tested, but I think it's a little bit too soon for the market to get worried about rate hikes or any major adjustments on the short end of the curve.
So do you expect that two-year yield to stay below 1%?
I think that
I
think two-year yields will stay within the 1% range from now to the end of the year. I think the markets have quickly forgotten that we've had a 6-month window of great returns in all these other asset classes where we're heading up against year-end and quarter ends, which might either force investors to scale back their risks or actually book profits. I think that combination and just the looming uncertainties of how balance sheets are still in a tough spot into year-end will push people into the front end of the curve.
All right, ahead of the auction results, I was reading some of your comments. You said down the road supply will at some point matter if risk markets continue on their merry way. So with the Fed wrapping up its purchases, is the level of demand we're seeing today sustainable?
Well, the notion before was that the reason why the Treasury auctions were doing well is because the Fed was on the other side buying the debt. That was providing liquidity and ironing out a lot of the anomalies in the Treasury curve. Now that we've kind of fixed a lot of those issues, I think that now we're seeing true earnest demand coming from investor base, not just strictly on the backs of the Fed buying debt as well.
So you also write the belly of the curve is very important to the Fed. Why specifically?
Because all consumer-based rates at the end of the day are indexed in one way or another to the 5 to 7 year part of the curve. And that's the part that's most sensitive if we have an adjustment in Fed rhetoric. Okay,
so then the Fed's wrapping up its purchases of Treasuries. What's it going to do with all these Treasuries? And the broader picture is, of course, the results of its quantitative easing. It has this massive balance sheet. How is it going to unwind? What are we going to hear tomorrow in particular?
I think it's important to note that what the Fed has done by buying back 300 billion Treasuries is basically brought it back to where it used to be pre-crisis levels. Before the crisis, the Fed owned 800 billion Treasuries. At the end of the program, they owned 800 billion Treasuries. In between there, they immunized programs, they sold Treasuries. Now they bought them back. The real quantitative easing and the credit easing came from the mortgage purchases and the agency purchases, which lowered financing rates that helped the consumer at large. Now their Treasury buyback program comes to an end. What we should be focusing on is what are they going to do with the mortgage program and the agency program? Will those get extended beyond December 31st, which to me is a very abrupt kind of ending period. I think that we'll see something analogous to what they did with the TALF, which is for the other bank markets, that you'll see them extended into March of next year. They have to buy time.
I don't mean to rush you, George, but we have these breaks that just do not argue with us. Got to take a break. So George Goncalves of Cantor Fitzgerald, many thanks.